Happy Tuesday, everybody. Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. A piece of housekeeping first up. Tomorrow, of course, is Christmas Day. China does not take Christmas Day off, and so I will not take Christmas Day off either. There will be an episode as usual tomorrow. The country isn't on holiday. There will still be developments to cover, and so we will cover them here. I hope you all will be able to have a day off, though. For those who celebrate it, I wish you all a very Merry Christmas. I wish everybody happy holidays and a very prosperous New Year. Now, with that said, let's begin today's episode, and we start as we usually do with the economy. Peking University Professor of Finance, Michael Pettis, one who we quote often on this channel, has pushed back against state media coverage of the debt relief package announced in November. Specifically, that the debt relief package announced, quote, will transform the growth prospects of the economy by allowing local governments the fiscal space to sustain a steady and robust recovery, end quote, which was argued in a state-run China Daily article on Monday, yesterday. Today, the China finance specialist argued, quote, in fact, the debt relief package does two things. First, it shifts hidden debts back onto local government balance sheets where they belong, but this shift merely recognizes existing debt. It does not reduce it at all. It is true that the cost of servicing this debt will decline, but the total value of the decline is pretty small and won't make much of an impact on overall GDP growth. More importantly, the decline in debt servicing costs will come mainly at the expense of local banks who already need to be recapitalized. Second, the debt swap may indeed open up the possibility of local governments continuing the type of spending that allowed China to maintain its GDP growth targets, but it was precisely the spending that created the local debt problem in the first place. Shifting the locus of debt creation from local governments to Beijing doesn't solve the underlying problem of soft budget growth. It simply allows China to postpone the adjustment for another few years while it uses up the last clean balance sheet left, end quote. Next up for the economy. For the third consecutive year, Hong Kong's derivatives market has reached a new milestone. Over 377 million futures and options contracts have been traded on the Hong Kong Stock Exchange and Clearing Limited in 2024, marking a 14% increase from the previous year. The surge comes as stock market volatility in the region reached its highest levels in more than 2 years this October. Regular viewers will remember this period very vividly. Derivatives are financial instruments whose value is derived from an underlying asset, such as stocks, commodities, or indices. These tools include options and futures, which traders use to hedge risks or speculate on market movements. Options provide the right, but not the obligation, to buy or sell an asset at a set price, while futures obligate the holder to transact the asset at a predetermined price and date. China's stimulus measures earlier this year, including interest rate cuts and cash injections for banks, initially bolstered markets but later led to profit-taking. Increased equity volatility spurred investor interest in derivatives, both as hedging tools and speculative instruments. The HKEX further expanded its derivatives offering in 2024, launching weekly options on the Hang Seng Tech Index and 10 single stocks, including Tencent and Alibaba. These shorter-dated contracts gained rapid popularity, accounting for over 10% of total trading volumes for most underlying stocks in their first month. As demand for derivatives grow, experts anticipate further innovations in Hong Kong's market, supported by the nature of the roller coaster that is Chinese equities. Finally, for the economy, yesterday, Lingling, chief China correspondent for the Wall Street Journal, US-based Wall Street Journal, and author of the Wall Street Journal China newsletter, published a long and thought-provoking piece called "She Digs In with Top-Down Economic Plan Even as China Drowns in Debt." Later this week, I'm going to do a full unpacking of this excellent and deeply concerning article as an exclusive bonus video for Patreons and channel members. For today, though, I wanted to examine a short excerpt from the piece so that we can all get a sense of some of its points. Quote, Some are calling it a lost decade. More than 10 years into the Xi Jinping era, and it has become clear that much of China's growth under his watch was driven by unsustainable borrowing, real estate speculation, and investments in factories and infrastructure the country didn't really need. Difficult reforms that could have unlocked more durable growth, such as steps to increase consumer spending, were neglected in favor of policies designed to bolster Communist Party control. Now, China is drowning in debt, reeling from a property bust that wiped out trillions of dollars of household wealth and verging on a deflationary spiral. Growth has slowed, Western investment has collapsed, and consumer confidence is near a record low. And yet, as China squares off with the US for a second showdown over trade, Xi is digging in. He's convinced that his top-down approach to managing China's economy, with plans to make it an even bigger industrial power, offers the best path for China to eventually surpass the US in economic might. People close to Beijing's decision-making say nothing that has befallen China in recent years has changed Xi's belief that the US is fading as the singular superpower and that China's importance is rising on the world stage. She still believes that the East is rising and the West is in decline, said a foreign policy advisor in Beijing, referring to the pronouncement the leader made 3 years ago, when China's economy, driven by Western demand for its exports, experienced a short-lived recovery from the COVID pandemic. It might just not be a straight line in his view, they added. End quote. The whole article is excellent, and we will unpack it later this week. And speaking of how Xi Jinping sees the world, next up we move to ideology. In the recent December Politburo study session, Xi Jinping outlined a comprehensive strategy for China's border governance. This is governance in the sensitive and sometimes unstable border regions of the country, places typically through military conquest brought into the Sinophone civilization relatively late and populated with large numbers of non-Han. For example, Tibet, Xinjiang, and Inner Mongolia. It's no coincidence that these regions see the most critical international attention. The Politburo session focused on several key aspects. Now, we're going to quote the language from the official readout directly. It's worth noting some of these. 1. Economic development. Xi emphasized that border regions must not be left behind in China's modernization efforts, calling for high-quality development tailored to local conditions and integration into the national market. 2. Ethnic unity. He stressed the importance of building a Chinese national community in border ethnic regions, promoting socialist core values and strengthening ethnic groups' identification with the nation, culture, and the Communist Party. 3. Security and stability. She identified national security and social stability as bottom-line requirements for border governance, emphasizing the need for improved infrastructure and technological capabilities. 4. Theoretical foundation. He called for strengthening research in border studies and governance, developing an independent Chinese knowledge system in border studies, and building a qualified research team with strong political conviction. Obviously, this is a lot of politically euphemistic language. Quote, the overall message emphasized integrating border regions into China's modernization while maintaining security and promoting ethnic unity. End quote. Next up, we have one more development to cover, but just quickly, if you're getting some value from today's episode of China Update, don't forget to hit the like button. Liking, sharing, and subscribing is a tremendous help. Approximately 45% of regular viewers are not subscribed, so if you think you'll watch more of these in the future, it's a big help if you subscribe. And for those who want to go the extra mile and help keep China Update financially sustainable, where you'll also get access to bonus exclusive videos, or if you'd like to give a gift to the channel during this holiday season for Christmas, that's also very much welcomed. Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. Next up, the United States has initiated a formal investigation into China's alleged anti-competitive practices in the semiconductor sector, intensifying the ongoing trade conflict between the two nations. The probe, conducted under Section 301 of the U.S. Trade Act, will examine China's policies aimed at achieving dominance in the semiconductor industry, particularly in foundational technologies critical to sectors such as automotive, healthcare, aerospace, and defense. In a statement yesterday, Monday, the US Trade Representative accused China of employing extensive state subsidies and market manipulation to outpace global competitors, a strategy seen as threatening international supply chains and US national security. Potential outcomes of the investigation could include tariff or restrictions on imports of key chips from China, with the final decisions likely to fall to the incoming Trump administration. China has heavily invested in scaling up production of legacy semiconductors, which are used in everyday electronics and infrastructure. Despite facing export restrictions from the US on advanced chip manufacturing equipment, Chinese chip makers have made significant strides, supported by substantial government subsidies. Analysts predict that China could double its chip manufacturing capacity by the decade's end. The USTR's move underscores Washington's shift in focus from advanced AI chips to mature semiconductor technologies, whose importance became evident during the COVID-19 pandemic-induced chip shortages. A recent US Department of Commerce report highlights how China's production surge is driving pricing pressures, particularly undermining US chip makers' competitiveness. Beijing has vehemently opposed the investigation, warning of retaliatory measures and accusing the US of hypocrisy for subsidizing its own chip industry. The Biden administration has indeed moved to bolster the US semiconductor industry, including with a bipartisan subsidy bill. The US pushback to Beijing would be that this move was in response to China's already years-long practice of industrial policy and subsidization. US officials worry that China can flood and corner the market with older, widely available types of chips and tighten its grip on the sector. Earlier this year, the White House announced that it would increase tariffs on Chinese legacy semiconductors from the current 25% rate to 50% by 2025. This escalating semiconductor dispute underscores the strategic and economic stakes in the global technology race, with significant implications for industries worldwide. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Tuesday. For those who celebrate it, have a very Merry Christmas. And I will see you all tomorrow, Wednesday, on Christmas Day.